Hello everyone. Today we'll be discussing the important changes announced by the Reserve Bank of India on October 1, 2025. These changes aim to ease the compliance burden and provide greater operational flexibility to exporters, importers, and merchanting traders in India. The RBI's move comes in response to evolving global trade challenges and stakeholder feedback, and it's focused on simplifying foreign exchange and documentation processes related to trade. Let's start with merchanting trade transactions, or MTTs. Merchanting trade typically involves Indian merchants buying goods from one foreign country and selling them to another, with the goods not physically entering into India. This trade has its unique Forex challenges. As per existing RBI guidelines, complete cycle of merchanting trade should be completed within 9 months, and foreign exchange outlay had to be done within 4 months. Foreign exchange outlay means the time period within which export payment needs to be received by merchant traders after making import payment. Given the current global trade uncertainties, RBI has now extended this period from 4 months to 6 months. This additional 2 months provides more breathing room for Indian merchants to manage their foreign exchange flows without worrying about compliance penalties. The extension is expected to help merchants operate more smoothly by giving them flexibility to adjust to market situations without compliance stress. Next, let's focus on the simplified processes introduced for closure of shipping bill and bills of entry, specifically for small value transactions. To give you some background, RBI maintains data processing systems for export and import transactions. For export, it's called the Export Data Processing and Management System, or EDPMS, and for import, the Import Data Processing and Management System, or IDPMS. EDPMS and IDPMS is a centralized repository prepared by RBI to have a common source of truth regarding what shipment has taken place from India or abroad and what payment has been made or received by exporter or importer. RBI, customs, banks, exporters and importers have common data to rely upon, which avoid reconciliation issues and near real-time updation of shipments and payments. It helps to match of each shipment against its corresponding payment. Previously, RBI had proposed through draft directions in July 2025 a simplified reconciliation and closure process for small value export transactions under EDPMS. This was meant to reduce the frequent paperwork and verification steps for smaller transactions which traditionally cause operational delays. Now, based on positive feedback from exporters, importers, and banks, RBI has extended this simplified closure process to also cover small value import transactions reported under IDPMS. Exporters and importers can now close shipping bill and bills of entry up to Rs 10 lakhs based on self-declaration on quarterly basis in consolidated form and any other minimal documents as per their bank's requirement. What does this mean in practical terms? If you're an exporter or importer dealing in small value shipments, the frequency and complexity of document reconciliations like shipping bills or bills of entry will be lessened. This helps reduce procedural delays, allowing faster closure of transaction records. It results in fewer compliance formalities for low-value export and import consignments. The simplification particularly benefits MSMEs and small traders who often face higher relative regulatory burdens. These changes have been formalized in RBI's AP.dir series, Circular Number 12, issued on October 1, 2025. To sum up, these RBI measures are designed to create a more trade-friendly environment where procedural rigidity is eased, especially for routine and low-value transactions, and foreign exchange regulations are made more flexible. The longer Forex outlay period for merchanting trade provides merchants with more operational leeway. The simplified closure processes offer exporters and importers, especially smaller traders, relief from time-consuming and repetitive compliance procedures. All these steps align with RBI's larger goal of promoting trade and commerce while balancing regulatory oversight. I hope this detailed explanation helps understand how RBI is easing compliance for trade players through these new directions. If you are involved in export, import, or merchanting trade, it is wise to consult your bank or authorized dealer to understand how these changes specifically apply to your transactions and systems. Thank you for watching and stay tuned for more updates on trade finance regulations and best practices. To get more such update on trade finance, subscribe to our channel to explore what's happening in the world of trade finance.